Foreclosures just jumped 40% year over year. And the people driving that number are the ones you would least expect. Solid credit scores, steady incomes, borrowers who checked every box a lender could ask for. They are falling behind on their mortgages at a rate that nobody in the mainstream is really talking about right now. And that is exactly what we are going to get into today, because this is not one isolated problem. This is a whole set of different problems, all colliding at the same time inside the housing market. And when you connect all the dots, the picture that forms is a lot worse than what most people are realizing. So here is what we are covering. We are going to look at fresh data coming out of Canada that is essentially previewing what is about to happen here in the United States. We are going to talk about the hidden costs of homeownership and just how out of control those numbers have gotten. We are going to look at what Fannie Mae and Freddie Mac just did with insurance requirements and why it sounds like good news but is actually putting a lot more risk into the system. And then we are going to look at this whole push to tokenize real estate and why it is being introduced right now at this exact moment, which tells you everything about where affordability actually stands. A lot of people thought real estate was on its way to some kind of recovery, and in certain areas, affordability had actually started to improve a little bit. So there was some reason for optimism. But what is happening now has nothing to do with interest rates or any specific geopolitical event. These are problems that live inside the structure of the housing market itself, and they are getting worse. So let us get into it. The first thing I want to cover is data coming out of Canada. And I know some people are already thinking this does not apply to them here in the United States. But stay with me because it absolutely does. These two economies move together. The same trends that develop in Canada's housing market have a well-documented history of eventually showing up here. So when we see warning signs there, we pay close attention because it's basically a preview of what is coming. New data just dropped showing that mortgage delinquencies in Canada are rising. And the part that should catch your attention is where those delinquencies are showing up. The middle tier is getting hit hard. And that is where this story gets interesting. So we are talking about borrowers with credit scores between 620 and 680. A pretty standard borrower. Someone who manages their credit reasonably well, pays their bills, nothing alarming on paper. These are the people lenders were perfectly comfortable approving a few years ago. And that group saw delinquencies jump 30%. 30% year over year. That is a massive number. Sit with that for a second. But here's the part that should really get your attention. That 30% jump in middle-tier delinquencies actually outpaced the rise in delinquencies among subprime borrowers in Canada. The people who were always considered the highest risk category are falling behind at a slower rate than the people in the middle. That is not how this is supposed to go. That is a significant departure from the normal pattern. And what that tells us is that financial stress does not stay contained at the bottom the way people always assume it will. It moves. It spreads upward through the different economic tiers faster than most people expect. And here in the United States, we are already watching delinquencies climb at the lower end of the market. FHA loans, lower credit borrowers, that trend is already in motion right now. Canada is just showing us what the next chapter looks like before we have had to live through it. Now, I want to address something because I already know someone is thinking these borrowers must just be irresponsible. And that is genuinely not what is happening here. In Canada, most homeowners do not have a 30-year fixed mortgage the way Americans typically do. Their mortgages reset every 3 to 5 years. So when that renewal date comes up, the payment adjusts to whatever rates are doing right now. And rates right now are significantly higher than they were 3 or 4 years ago, when a lot of these people originally locked in. So you have someone who was completely managing their mortgage, fine, hits their renewal date, and suddenly their monthly payment goes up several $100s. And this is arriving at the exact same time that every other expense in their household budget has also climbed. Property taxes in Canada, insurance in Canada, groceries, utilities, all of it more expensive. Canada was not somehow left out of the global inflation problem. That hit everybody over the past 6 years. So now you have got higher costs across every line item in your budget, and on top of that, your mortgage payment just jumped. Something has to give. And for more and more middle-tier borrowers up there, what is giving is the mortgage payment. That is what the data is showing us. Here is something that a lot of people genuinely do not understand about credit scores, and it matters a lot for where this is heading. A credit score measures one specific thing. It tracks how well you manage the credit you already had access to, whether you paid on time, how much of your available limit you were using. That is the full picture it paints for a lender. Your savings account balance, your emergency fund, your ability to absorb a $400, $500 monthly increase in housing costs. None of that shows up. It is simply not designed to measure that. So when expenses spike faster than income, even the borrowers who looked completely safe on paper start getting pushed to the edge. And having a good credit score does not protect you from that. People do not realize this until they are already in trouble. And the delinquencies in Canada that are climbing the fastest are concentrated among homeowners with mortgages over $800,000. And that makes sense when you think about it. If you took out a mortgage for $1.5 million a few years ago, barely paid down any of the principal, and now have to refinance at today's rates, your payment could easily jump $500 a month or more. That is not a minor adjustment. That is a financial shock. And the condo market up there right now is not just under pressure. It has gone off a cliff. So now let us bring this back to the United States, because we have a very similar set of pressures building here. And one of the biggest ones is something I have covered a lot on this channel: the hidden costs of homeownership. Most people, when they think about what it costs to own a home, they are thinking about their mortgage payment, the purchase price, the rate, what the monthly number comes out to. That is the figure they plan around. What gets dramatically underestimated are the surrounding costs: property taxes, homeowners insurance, HOA fees if you have them, and the constant ongoing expense of maintaining a physical structure. And a lot of people sort of know those things exist, but I do not think most people understand just how fast all of those expenses have climbed over the past 5 to 6 years. Because once you actually look at the numbers, it is genuinely staggering. This is where a huge amount of the financial stress in the housing market is being generated right now, and it is spreading in the same direction that we just watched it spread in Canada. Let me give you a concrete number that puts all of this in perspective. In 2020, the average homeowner in this country was spending roughly $400 a month when you combined property taxes and insurance. Run that same calculation today, and you land at around $600. That is a 50% increase in just a few years, and that is the national average, which is being pulled down by the cheaper markets. Anyone living somewhere expensive is paying well above that number. Now, I'm going to pull up a chart here that covers all the different homeownership cost categories going back to 2015. 10 years of data. And when you look at it from 2015 to 2019, everything is ticking up gradually. Principal, interest, taxes, insurance, all climbing incrementally, nothing extreme. Then 2020 hits and everything accelerates. But the one category that completely separates itself from the rest is insurance. Since 2019 alone, premiums have climbed 70%. Go back to 2015 and the 10-year increase is almost 90%, nearly doubling in a decade, with the bulk of that packed into the last 5 years. And even at the low end, total average homeownership payments are up about 30% over the past 5 years. Most people have not seen their wages grow 30% in that same window. That gap is exactly where the stress is coming from. Now I have a map here showing the change in average monthly insurance premiums across the United States between 2019 and 2026. The darker the shading, the bigger the increase. And when you look at it, there is really nowhere on that map that avoided this. It is dark coast to coast, across the South, the Midwest, the Mountain West, everywhere. This is not a regional story. It is a national one. And here is where the Canada situation and the US situation run exactly parallel. The same pressure that is forcing middle-tier Canadian borrowers into delinquency through mortgage resets is hitting American homeowners through these exploding insurance and tax bills. Different mechanism, same result. People who looked financially stable a few years ago are finding out their housing costs have outrun their income. And we just saw foreclosures tick up 40% year over year here. That is not a coincidence. That is the direct mathematical consequence of housing costs growing faster than the incomes that are supposed to cover them. And it is only going to get worse before it gets better, because nothing driving these costs is going away on its own. Here is something worth really sitting with. About 40% of your total monthly housing outlay goes to the surrounding costs. Property taxes, insurance, HOA fees, maintenance. Nearly half of what you spend on your home every single month has nothing to do with the fixed mortgage you negotiated when you bought the place. And the only part of your housing payment that is actually locked in and stable is that principal and interest number. Everything else is floating. Everything else can go up, and right now everything else is going up. So that core mortgage payment that you locked in at closing is increasingly becoming just one piece of a much larger and much less predictable monthly obligation. And this matters even more for anyone who went with an adjustable rate mortgage, which have been making a major comeback in this market cycle. Because with an ARM, you do not even have that one locked-in piece. The principal and interest can reset, and then everything else on top is also climbing. That is a compounding pressure that only intensifies over time. Now, this does not just affect current homeowners, it bleeds into the entire market. When a potential buyer goes to get approved for a mortgage, the lender pulls up the property tax rate for that area, checks what current insurance costs look like, and folds HOA fees into the debt-to-income calculation. All of that. So as those surrounding numbers climb, the maximum mortgage a buyer can qualify for actually shrinks even if their income has not changed at all. Which means in order for homes to sell, prices need to fall to compensate. And inventory is rising in most parts of the country right now. More supply hitting a market where buyers have less purchasing power than they did before because the surrounding costs of ownership have expanded so dramatically. That combination creates sustained downward pressure on prices. And that pressure is not going away. It builds until prices come down enough that the math works again for buyers. We are not there yet. Total average homeownership costs are up about 30 to 40% over the past 5 years. Wages have not kept pace. And until that gap closes, either through price declines or through income growth, the pressure stays on. And income growth alone is not going to close a gap that wide. So prices are the variable that has to move, and they will. Now, on top of all of this, something just happened at the federal level that most people have not fully absorbed yet. Fannie Mae and Freddie Mac announced they are changing the insurance requirements for the mortgages they back. And you need to understand the scale here. About 70% of all mortgages issued in the United States are backed by Fannie Mae or Freddie Mac. That is the backbone of the whole American mortgage system. The change they are introducing allows borrowers to use what are called actual cash value insurance policies instead of full replacement cost policies. So let me explain the difference because it is important. A full replacement cost policy means if your home is destroyed, the insurance pays for what it actually costs to rebuild it at today's prices. An actual cash value policy pays based on the depreciated value. So if your roof is 15 years old and a storm takes it off, the actual cash value policy pays you what a 15-year-old depreciated roof is worth. The cost of installing a brand new one is your problem. The reason they are doing this is pretty transparent. Insurance has gotten so expensive in so many markets that it is literally preventing people from qualifying for mortgages. So the response is to allow cheaper policies to count as acceptable coverage. Monthly costs drop, more people can qualify, and it looks like affordability improved. But what actually happened is the risk just got shifted. Instead of the insurance company absorbing more of it, now the homeowner carries it. And the real-world consequences of that become clear the moment something goes wrong. When a storm hits, when a wildfire rolls through, when any kind of disaster damages or destroys the home, The gap between what the actual cash value policy pays out and what it actually costs to rebuild is going to be enormous for a lot of these people. And most of them will not have the savings to cover that gap themselves. And what happens when you cannot rebuild and you cannot sell into a damaged market? Foreclosure. More distressed inventory hitting a market that is already oversupplied. And this is already a problem with full replacement cost policies. Insurance companies are already notorious for finding loopholes and reasons to underpay claims. You can only imagine how much worse that gets when the policy itself already builds in a lower payout from the start. Instead of fixing why insurance is getting so expensive in the first place, what we are doing is just changing the definition of what counts as adequate coverage. That is a band-aid, and eventually it comes off. And while all of this is happening, there is something else being pitched as the fix to the housing affordability problem that I want to talk about. Tokenizing real estate. The idea is that instead of buying an entire property, you could own a fraction of one through blockchain-based tokens. Instead of needing hundreds of thousands of dollars or going through a full mortgage transaction, you invest a few $100 and own a piece of a property. Now, if you have ever owned shares in a REIT, you already have something conceptually similar to this. The tokenized version is just supposed to be more accessible, more liquid, with lower minimum investments. The pitch is returns somewhere in the 6 to 12% range, the ability to sell your position anytime, global access to properties, everything tracked transparently on a blockchain. Dubai is moving aggressively on this. Europe is picking it up fast, and now it is being pushed as a solution to affordability here in the United States. But real estate is not a stock. A share of stock has no roof that needs replacing, no title history to untangle, no local zoning regulations to navigate, no closing process attached to it. Real estate has all of that. And in the United States, a lot of these tokenized real estate products would likely be treated as securities, which brings investment restrictions, limited liquidity, and compliance layers that make them a lot less flexible than the promotional materials suggest. But more than the technical issues, think about why this is being proposed right now. Housing affordability is at or near its worst level ever recorded. People cannot buy whole homes, so the industry starts packaging up pieces of homes instead. That tells you everything about how broken the system has become. And it rhymes pretty closely with the thinking that built up to 2008. Now let me show you what all of this looks like in a real listing right now. There is a property that was purchased in May of 2024 for $1.3 million. That buyer felt good because the same property was listed at $1.6 million in 2023. So they got it for $300,000 less than the original ask. Then they tried to rent it, cut the rental price multiple times. Nobody took it. So they listed it for sale at $1.475 million at the end of 2024. Nobody bought it. They have since cut down to $1,399,000. Still sitting with no buyers, they paid $1.3 million. They cannot sell at $1.399 million. Once you account for commissions and closing costs, they would barely break even at full price. And full price is clearly not happening. This property is on track to produce a real financial loss, money genuinely out of pocket on what was supposed to be a premium asset. And that story is not unique. It is happening all over the country right now at different price points. People who bought at or near the peak with the expectation that prices would keep moving up are now sitting on properties they cannot rent and cannot sell at a number that gets them out whole. And every one of those situations, every forced price cut, every new foreclosure listing adds to the downward pressure on everything surrounding it. So here is where all of this lands. The housing market is not dealing with one problem. It is dealing with a whole stack of them that are feeding into each other simultaneously. You have financial stress spreading upward from the lowest income tiers into the middle class. You have hidden homeownership costs that have outpaced wage growth by a wide margin. You have a federal rule change from the agencies backing 70% of all mortgages that quietly transferred risk onto homeowners who mostly have no idea it happened. You have a new financial product being packaged as a solution to affordability that follows the same structural logic as the last housing crisis. And you have real sellers in real markets taking real losses right now. None of this resolves quickly. These are not temporary blips in the data. These are structural problems that take time to work through the system, and in the meantime, the pressure on prices keeps building. But here is the other side of that. For people who have been patient, who have kept their finances solid, who resisted the pressure to buy at peak prices because the math just did not work, your patience is going to be rewarded. The downward pressure on home prices is not done yet. Inventory is rising, buyer qualification capacity is being compressed, costs are not retreating. The math is going to keep shifting in favor of the prepared buyer for a while longer. The people who come out ahead in this market cycle are not the ones who jumped in at the top. They are the ones who had the discipline to wait for the math to actually work in their favor. And that time is getting closer. So keep doing the research. Stay ahead of this. Make sure you are subscribed to Atlas News Report so you do not miss updates as this continues to develop. Hit the notification bell, share this with someone who needs to see it, and check out the video on screen right now if you want to keep going. I will see you in the next one.